So as you guys know, banks are usually the first to kick off earnings season for each quarter. And because they're so heavily tied to the health of the economy, I like to always take a look as soon as they announce to see if they're showing any signs or signals that the economy is either doing well or struggling. Well, this latest quarter is especially important because we've been having tons of recession indicators triggering over the past couple years. In fact, I even just did an entire video on a few of them that have had a 100% accuracy throughout their history, and they also just recently triggered too, so it's pretty alarming. However, it just so happens that these banks and the media and analysts that are covering them, well, they're all saying that earnings were fantastic, so much so that JP Morgan even claims that there is no recession in sight, guys, that we've successfully had a soft landing, and their stocks went up because of it. But in today's video, I'm going to show you a bunch of stuff to the contrary that Wall Street is, I would say, conveniently ignoring, and it's also pretty alarming. So sit back, relax, and let's take a look at these earnings and the health of the overall economy. All right, now just for some context, the five largest banks in America are, of course, JP Morgan Chase, followed by Bank of America, Wells Fargo, Citigroup, and US Bancorp, together holding many trillions of dollars in assets. Well, Chase and Wells Fargo were the first to report last Friday, and Wall Street and the media responded so well to them that they actually helped lift the broader market up to new record highs. Now, to be fair, Chase was, at least in my opinion, the best performer of the bunch, as is typically the case with Chase. It's why I've always invested in them myself, because I just feel that they are really the best overall run bank in the world, and they showed that strength on earnings, posting better than expected results on both the top and bottom line, while also raising their annual interest income forecast for the full year, which is actually a pretty big deal because the Fed is, of course, lowering rates right now, and everyone expects that to continue. So the fall in interest rates should technically mean lower interest income that banks can generate on the loans they give out. But despite that, again, Chase actually raised their interest income guidance. So it's pretty interesting why they would do that, and I'll explain exactly why they did it in just a second, so hold tight on that one. But up next, we also had Wells Fargo report, who came out and also beat analysts' expectations, with even BlackRock reporting that day too, the largest asset manager in the world, and they reported another record high in assets under management for the third straight quarter. And all three of those stocks rose as a result. For example, Chase climbed over 5% this past week and continues to trade at a record high. Bank of America is also right near a record high too, by the way. Speaking of which, though, we then had Bank of America and Citigroup report on Tuesday, which is the day I'm recording this video myself. And those are the number 2 and number 4 largest banks, who also reportedly had a great showing, beating analyst estimates as well. However, all of this was, at least in part, really, I would say almost entirely, due to the fact that they had increased trading revenue, meaning that it's really the stock market that is lifting these companies up right now, not the economy. The market just continues to set new record highs with increased trading volume, and everyone keeps buying in. But could some of that be artificial? Could some of that even be a little bit of a bubble going on with the stock market? Well, if you ask the banks, they tell you that everything's great. In fact, JP Morgan just flat out came out and said that we have officially succeeded in a soft landing, with the CFO saying, quote, broadly, I would say these earnings are consistent with the soft landing narrative, and the fact that companies are optimistic is pretty consistent with this kind of Goldilocks economic situation. And it wasn't just them. Analysts from Wells Fargo also came out and said, quote, the market's pretty convinced that we're going to have a soft landing, and that inflation, even with CPI being a little bit higher than expected yesterday, is going to be moderate. So basically saying there that inflation was actually higher than we expected, and yet it was still low enough to where the Fed can really continue to lower rates, which ends up boosting the economy and potentially helps it avoid a recession and instead have that soft landing that they're all talking about. And even other analysts are also echoing these same talking points too. UBS, for example, said, "We've had some good earnings reports from leading financial companies, which is a good start to earnings season, and it bodes well for the economy." Adding, "When financials do well, this is what a soft landing looks like. It's a positive overall sign for the economy and sets a positive tone for earnings releases in other industries." But does it really though? Are these banks actually performing as well as they claim? And is the economy as strong as they're making it out to be too? Well, the answer to both of those questions, guys, is no. Just flat out, the answer is no. And I'm not being biased. I don't have any kind of ulterior motive. I don't have any other reason to say this other than just telling you guys the truth and just showing you the facts here. And the facts are that banks are actually in decline. And the economy is not as strong as they say it is either. And I can prove it. In fact, here's the proof. Let me run you through it. So first of all, for all the talk about the economy being so strong, inflation actually rose last month, while jobless claims also climbed to the highest level since more than a year ago, which is why everyone expects the Fed to continue cutting rates, with about 90% of traders pricing in another rate cut this November. And yet banks and analysts and the media, they keep saying that these banks did great. But when you look deeper into their numbers, you actually find that's really only because they're having that increased trading profit from markets breaking new record highs and continuing to climb, despite the economy not actually being quite as strong as they say it is, while their core businesses actually continue to struggle. For example, JP Morgan and Wells Fargo, they both saw their investment banking fees rise by over 30% year over year, and yet their profits actually declined. Their overall profits declined by 2% and 11% respectively, a clear sign that the majority of their underlying business is actually worse than maybe they're letting on. But because both declines were still better than analyst expectations, it was just considered an overall positive and their stocks went up. Same goes for the other banks too. Goldman Sachs, for example, saw their investment banking fees rise by 20%. Bank of America reported their highest third quarter trading revenue in over a decade. And even Citigroup saw their investment fees rise by over 40% as well. And yet profits still tanked. Bank of America even witnessed a double-digit decline in their net income, saying that it stems from higher provisions for loan losses and rising expenses. That's a clear sign that the economy is actually not as great as they're making it out to be. At least they don't think so. And even their net interest income also fell by almost 3%, despite the country still having incredibly high interest rates during the period. And yet banks seem to actually be excited about interest rates coming down. But why would that be? If they primarily make their money from interest on loans, then why would they want interest rates to come down? Well, I told you I would come back to this and explain why. It's actually pretty simple. They know that the economy is actually not very strong, hence why their interest income actually went down. You would think it would go up with the rates as high as they are, but no, they actually went down. And so maybe the economy is not as strong, but if the Fed lowers rates, which you would think would be counterproductive for them, but if they lower them, it could spur on new growth to the economy that these banks can actually benefit from. In other words, even though their interest income per loan would be less, the volume of loans would actually go up because lower rates means people and businesses will be taking on more new loans, and thus it ultimately helps the banking industry, which is exactly what Goldman Sachs CEO just said. Quote, "The beginning of the rate cut cycle has renewed optimism for a soft landing, which should spur increased economic activity." Remember, guys, just because interest rates are high, it doesn't necessarily mean that it's a great environment for banks. That's only the case if the underlying economy also remains strong, which right now, I think I could argue that it's absolutely not strong. And that's why they want rates to actually go down so that the economy can rebound and improve. The only question, though, is if this whole rate cutting cycle is happening soon enough, because some are trying to spin it as if the recovery is already taking place, but I'm not so sure it is. When you look at debt levels and consumer confidence, it actually still looks a little scary out there, just being honest. In fact, the consumer confidence index just fell by over 10 points for current business and labor market conditions. And the expectations index also declined by nearly 5 points, down to 81.7, which, as the conference board points out, a reading below 80 usually signals a recession. Well, we're definitely really close to that. We're at 81. It's supposed, 80 or less signals a recession. And you look at what the report says here, quote, consumer confidence dropped in September to near the bottom of the past 2 years. And it was the largest decline since August of 2021, with all 5 components of the index deteriorating, adding that consumers are worried about business conditions and the labor market and are pessimistic about the future too, and that the deterioration across the index likely reflects consumer concerns about fewer hours, slower payroll increases, and fewer job openings. It was also the steepest drop among those aged 35 to 54, which is like the main, working middle class. And it says those earning less than 50,000 experienced the largest decrease, while those earning over 100,000 were the most confident. But yeah, obviously, if you're rich, you're going to have money. You're not going to be as worried. You can move money around and figure out ways to survive and maybe even come out of a recession with even more assets that you bought on the dip, right? So it's not something to really be afraid of. But for the majority of people, who make well under that, yeah, those are people that are actually drowning in debt right now with not enough opportunity to match it. And again, you don't have to take my word for it. Just look at how steep of a rise we've seen in credit card debt among large banks for consumers, with the total among all commercial banks. This is for consumer credit card debt. It's risen well above $1 trillion. So we'll have to see what happens. Again, guys, long term, I'm always going to be a long-term optimist when it comes to America and the economy. But all I'm saying here is that these banks may not be doing as well as it's being portrayed out there. And the same, I think, can be said for the economy. Now, I don't think that that's any reason to panic. Interest rates are coming down, and that really should actually boost the economy longer term. I'm actually confident about the long-term vision because we have high interest rates and they can come down, and that should actually boost the economy and should be good for stocks longer term. But for JP Morgan to just kind of come out and say immediately now that it's already been proven that we are for sure in a soft landing, I'm just not sure I'm ready to call that, so soon. I think we could actually still have some volatility headed our way. Of course, I hope for no recession. I don't want people losing their jobs and struggling. That's not something I want. I want the economy to perform well. But as an investor, I'm also not afraid of a recession either, because I do think that stock prices are a little disconnected from the current state of the economy. I think stock prices are a little too high. I wouldn't mind seeing a correction in the market, prices coming down a bit, even a crash in the worst case scenario, but just kind of, coming down a bit, I think would be healthy, and we could get some cheaper prices on stocks. When, I do think a lot of stocks are a bit high at the moment. Speaking about stocks, so full disclosure, the only 2 banks that I own that we talked about today are Chase and US Bancorp. Lately, USB, I would say US Bancorp has been my favorite because of the cheaper valuation and bigger dividend than most of their peers. However, they haven't reported at the time of me making this video, but I believe they report the day that I'm posting this video on Wednesday. So you should be able to just look up their results right now and see if they did well. Hopefully they did good. But yeah, overall, I continue to think that really Chase is still, I would say, the best overall run of the big banks, with the highest quality, the largest size, the most trusted out there. And that's why, again, we saw them actually take the smallest hit of the group too, when looking at their overall profits. But, with JP Morgan Chase, you also have to pay a premium for that quality. And with how shaky the economy is right now, I'm just not really feeling like buying any shares of bank stocks at the moment. I'm only just really holding what I have in those. And instead, I'm buying other stocks that I think look a lot more attractive out there in the market at the moment. And of course, I make videos on that all the time. So you could just look through my videos. You'll see all the stocks that I buy all the time. But yeah, what are you guys doing? How do you feel about everything we discussed today? I'd love to hear your thoughts. Let me know down in the comment section. Let's have a fun conversation. And regardless, I hope you're all doing well out there. And thanks for stopping by. Thank you for the support, and I'll catch you in the next one. All right, take care, my friends. Bye-bye.